Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So as you know, I absolutely love doing research and finding out basically more about individual stocks more than ETFs. I love ETFs of course because that it gives you that peace of mind buying a basket of companies and just like diversified and everything else and just relaxing about it, just buying every single month and leaving it alone. But there's something about doing doing the research and finding out individual companies that really helped me over the last whatever years. And what I want to do today is basically I've been looking at the portfolio thinking, okay, there are some companies that are slightly dead at the moment that have not done really well for me. And while I'm still on that wealth accumulation, and what I mean by that is while I'm still building the portfolio, I'm buying high quality businesses. I want to make sure the companies that I'm buying are actually doing well for the portfolio and they're not just dead and just sitting there and collecting dividends maybe. So I've been doing a little bit of research and I just tried to find some sort of a high growth companies, but they're not really too risky. So I'm going to share with you guys today 5 companies that are on my wish list. Okay, they're all technology companies that I would love to buy them if there was a dip in the market. Some of them are coming back to fair values at the moment. Some of them have gone up so much. So I'm going to share with you guys 5 companies that potentially would love to add to the portfolio in the long run, inshallah. I did own some of them long time ago. I don't have any of them in this portfolio. And some of the companies that are genuinely been in this portfolio, but since some of them have been in this portfolio since the beginning of my portfolio. So companies like Union Pacific and so on, I really like them. And new additions like Salesforce, a great company, but I want to find more of Salesforce's, inshallah, moving forward. So that's why I try to look at technology companies have done absolutely amazing for me. Companies like Visa, for example, although it's a financial sector, it's done really well for me over the last whatever years, 25% up, almost 1,000% up. You've got companies like Qualcomm. Qualcomm was one of those companies that were down so much over the last whatever years. Recently I had to take some profit off the table. I sold 10 shares of this company and it's still up basically over £2,000. So when I looked at the portfolio, the companies that done really well are mainly the technology companies. But when you look at the S&P 500, the companies that have been carrying in the markets for the last 3-4 years are technology companies, and I don't think that trend is going to stop anytime soon. Companies like Broadcom that I've been buying when it was trading about 16 to 18 PE, right now is in the 30s. Like, it's done absolutely amazing. Look at the basically company like ASML. So I want to share with you guys today 5 companies on my watch list that I would love to buy if there was a dip in the market moving forward. Now, if you have not joined us to the Patreon account where you get access to a lot of the buys and sells and everything else in between, and where you can actually basically join a lot of brothers who are sharing really good practices, like they share their portfolios, they share questions, answers, news, everything about what's happening in the stock market, and everything they're doing is basically based on Sharia compliant. Please join us to the Patreon account. Then you get access to the Discord and it will cost you about 15p per day, inshallah. Right, let's get started. First company I want to talk about today is KLA. KLA is one of those companies I wish I never sold, and I genuinely mean it, because I sold it when it was trading about 300. Right now we're looking about over $819 per share. It has a market cap of 111 billion. It has a wide economic moat. It's one of the semiconductor equipment side of things, so they deal with that side. It has a wide economic moat, dividend yield of 0.7. You wouldn't buy this company for the dividends, but if you did, you will not be disappointed because the payout ratio is very, very low, so they have room to increase it. The latest increase was 12%. The 5-year growth rate was 16%, and the dividend streak of 13 years. So for 13 years, they've increased that dividend, and you get $5.80 for every share of this company that you own. Safety is 71%, so really safe. The 5 in terms of revenue side of it is group basically about 12% in the last 5 years, 16% when it comes to EPS, profit margin of 27%, return on equity of 90%, and return on invested capital of 33%. This is what high quality business looks like. Free cash flow about $3 billion. Total return in the last 10 years, we're looking about 29%. Growth estimate in next year 22%, 6% after that, 56% premium right now. $530 per share is where they think the price should be. Now, one of the major concern about semiconductor companies is very cyclical. What I mean by that is it's trendy. It's not trendy. Basically, it's it's a seasonal, if you like. So then when the economy is doing well, companies are investing a lot on their semiconductors and so on, which is basically which is basically what's going on right now. These companies tend to do well. If the economy is not doing well, no one is buying new technology, no one's basically innovation is not great, whatever, these companies do not do well. So you have to be careful. Right now they're doing well. At the time when I was selling, it was really doing well. Then it went down quite a bit. I was happy with my basically investment. Then of course it came back and bounced back again. Now Lamb Research basically is another, basically these two are competitive, so they do more or less the same thing. $136 billion, wide economic moat, over $1,000. I've never bought this company, but I was talking about this when it was trading about 400. The fact it was actually undervalued at the time. Right now, over basically 50% premium right now, according to Morningstar. 0.8% is what you will get for dividend yield. 27% in terms of payout ratio. Latest increase was 16%. The 5-year growth 22%. 9 years of increase in it. $8 is what you will get. And safety of 55%, which is quite low. Normally we're looking about 60. In fact, let me just check if that's the case. Okay, LRCX. I just want to make sure. Yeah, no, it's 66%. It's not 50. 55%. 55% will be it will be crazy, because that will be lower than the 61% required. So it wouldn't be really safe. So yeah, so it's safe. Fifth in terms of revenue growth in the last 5 years, we're looking about 8%. 12% when it comes to EPS, profit margin 25%, return on equity 43%, and return on invested capital 31%. $4.5 billion of free cash flow, which is quite nice. Free cash flow is really important, especially for those companies that are still growing, so they can actually, a lot of things they can do with that money. They can pay dividend, they can buy back their own shares, they can pay off any debt, they acquire other businesses. Okay, and paying off debt and basically lowering the debt levels is really important to a lot of companies. So they use that money, they buy other companies and so on. In terms of the total return the last 10 years, look at this, 32%. Okay, annualized, you would have received the 32% for this company. Growth estimate next year 21%, 11% after that. Like I've already said, 53% premium, $680 per share is where they think the price should be. Next one that we're looking at that I would potentially love to add to the portfolio is one that I used to own, and when it was trading about 100 something. Right now it's 386. I think a lot of the banks recently came up and increased that basically to about I think I'll show you at the end. Basically, I think they've increased it to the price targets for this company over 400 right now. But it has a 94 billion market cap. Soon will be up. I'm sure soon will be 100 billion. Moat is narrow right now. Of course, this is one of the cybersecurity companies out there. They don't pay, of course, any dividend yet. For the 5-year growth, we're talking about 51%, EPF 75%, profit margin, return on equity, and return on invested capital almost non-existent. So they are still growing, but the fact that these are positive is really good. Free cash flow over $1 billion, which is really nice. And in the last 5 years, not 10 years, the total return is 46%. They expecting to grow about 23%, then 24% after that, 23% premium right now, $300 per share is where they think the price should be. If the market actually corrects, this probably will come back down to at least the minimum half of these prices. This is a very volatile company, so I wouldn't be surprised if we see a correction. That 23% will probably be wiped and become straight away a undervalued stock. So right now I wouldn't touch it, but I will be waiting for when it happens. Okay, so just to quickly show you guys, and when it comes to the earnings expectations, I want to see what they expect. So about double digits this year, so they're expecting almost 30%, 23%. Remember, there's so many analysts looking up. There's 48. That's the highest I've seen in age. So for the next 2 years, and then 14 for basically 2027. So yes, double digits every single year, which is nice. Revenue 30%, 26%, 25%, 33%. Again, if you just focus on the first 4, and until 2027, the company is expected to grow double digits every single year, which is absolutely amazing. Another company that's been talking about basically when it comes to AI and everything else is Arista Networks. This is a kind of competitor with Broadcom. If you think about it, the Broadcom and Cisco as well. It's gone up so much in the last few months, I think, it's just with everything, with all the other companies, with Broadcom and so on. Right now, it has a market cap of $97.6 billion. And it has a wide economic moat, $330 per share is where the price is at right now. Now, in terms of dividends, of course, they don't pay any dividends. 18% in terms of the revenue growth in the last 5 years, 19% in terms of EPS, 33% profit margin, which is really good. 34 when it comes to return on equity, and 32 when it comes to return on invested capital. So this is not a new company. This has been around for quite some time. It's a very profitable business. Free cash flow $2.1 billion. Total return in the last 10 years 34%, and growth estimate for next year 13%. 5 years after that, 19% expected. Fairly valued right now, which is interesting. $270 per share is where they think the price should be. Right now it's $330. It might go up a little bit more, but it is really interesting the fact that it's actually is around here now. So we will see what happens in the next few months, okay? But if it comes back down to about 270, 250, that would be really good, because remember, when the reason I said 250 is even though this is what they're saying, add a little bit of a margin of safety for yourself. So 250 will be absolutely perfect. That's about $80 from where we are now. Will that happen? If it happens, of course, you'll take that chance. If it doesn't happen, of course, well, leave it alone. And just to show you guys, basically, when it comes to EPS expectations for these companies, double digits every single year. And when it comes to revenue, is almost exactly the same. So this is one of the reasons I really like the company. It's done really well, and it's very innovative business. And finally, AMD, another one that I used to own. I think I had this basically shares of this company between $50 per share to about 100, closer to 100, and then I sold it out early 2020, I think it was. Right now it's basically trading $160 per share, 259 billion market cap, which is absolutely huge. But it has a narrow economic moat, no dividends yet. In terms of next basically the last 5 years, the revenue grew about 26%, in the EPS grew about 48%, which is absolutely amazing. Profit margin, return on equity, return on invested capital is almost non-existent, but they do have some free cash flow, which is quite nice, $1.1 billion. Total return the last 10 years, we're looking at about 44%. Growth estimate next year 59%, 31% after that. Fairly valued as well right now, $145 per share is where they think the price should be. Now, if we have a look at AMD here, I want to see what the analysts are expecting from this company in terms of EPS. 33%. 57%, 30%. This is really a high growth business. And in terms of basically revenue side of it, this year they're expecting yeah, it's okay, about double digits, then about 27%, then 17%. And if you look at even the last, this is 5 analysts looking about 18%, which is, remember, by the way, this does not mean it's going to happen. This is just an estimation, so you have to be, take that with a pinch of salt, of course, as always. In terms of ratings, I think, let me have a quick look what they're expecting. 31 people are basically, analysts are saying, is actually strong buy. 7 buys, 10 holds, and no sales whatsoever. 18% upside from where we are right now. But remember, Morningstar is basically using intrinsic value evaluation, so they're using discounted cash flow models, whereas these guys, they have done their own discounted cash flow models, but the Seeking Alpha is basically collecting all the basically average prices from all these analysts. That's basically what they're doing. Before I forget, also the Sharia compliance side of things, basically no worries when it comes to any of these companies. In terms of Sharia compliant, you can just pause the video, have a look at it. But they are really interesting companies. Like I said at the beginning of the video, I wouldn't buy all of them in the same portfolio, because that would be absolutely crazy. It wouldn't be crazy, but it would be really good, and it will probably be a high growth portfolio, whatever. But for me, the companies that I really would like to is a KLA. This is a really great company. I did own it at some point. I sold it. CrowdStrike, I would love to own this again. But again, the fact that it's right now 23% premium, I'm going to leave it alone. And AMD seems really interesting. If AMD comes back down again, maybe to $120 per share, which it can happen in over 2 days with it knowing AMD, I potentially might start looking at it again. I do like semiconductor companies, but I do also already own Broadcom. I own Qualcomm and ASML and so on. So I don't want to overload it again. The reason I actually sold some of these companies was because at one point I had very tech kind of concentrated portfolio. Majority of my stocks were actually in the technology side of things. Anyway, that's what I wanted to share with you guys. If you enjoy this type of content, like I've always said to you guys, it takes a lot of time and effort to put these videos together. So I would really appreciate if you can join us on the Patreon account. Like I said earlier, it will cost you 15p and you get a lot out of it, inshallah. Have a wonderful day. Assalamu Alaikum.